So yeah, we tend to spend an awful lot of time talking about the Fed and its monetary policy, but we cannot, leave China out of this, because they have been the world's growth engine since the turn of the century.
What are the biggest risks facing global financial markets as well as the global economy moving forward through this year and into next? What could come from the US Fed or possibly from China? Unpacking this topic, we have this clip from an exclusive recent CRA client webinar in which senior analyst Becky Mahlobo discusses this issue with financial experts Neels Heyneke and Kevin Colglazier. We hope you enjoy.
That's exactly the scenario. I think that by the summer of next year, by the middle part of next year in the US, that scenario will probably play out. If you think about it, where we are currently, you have the US president calling for higher cash rates to quell inflation. That's a kind of once in a lifetime event. Most politicians typically call for lower cash rates to stimulate growth. And I think that, not touching on the political issues or the electoral issues, but as the economy slows, then I think we'll be back to the more typical, which is, from a political perspective, the desire for re-stimulation. And I think that, as you point out, by next summer or by middle of next year, you'll have the Fed probably in a halting phase, if not potentially, depending on how poorly things turn out, in a sort of stimulative phase. And if I could just add to one point of this, it seems to me there's a lot of contradiction here in terms of there's a discussion about how the economy is robust and how there's all this spare cash sloshing about. But then if you look at the consumer sentiment numbers, they're horrifically low.
Yeah.
And I don't think much attention is being paid to who owns the cash. I mean, there was this concept of a K-shaped recovery about a year and a half ago, right? Mm-hmm. Which was the bottom 50% of the economy is doing okay, but the top 50%, or actually the top quarter, is doing fantastic because of equity and housing price rises, because they own most of the equities and they own the bigger houses. And actually, I think if people were to look at a little bit more carefully as to where the cash is, that sort of mythical excess cash in society, there's some Brookings did a report recently that showed something like 2/3 of that cash is held by the top 20% of the economy. So I'm just saying that I think that, to your point, in terms of will the Fed sort of have to cease by the middle part of next year, or maybe even earlier, I think that bears out, because I don't think there's as much consumer cash and consumer strength sloshing around as people seem to think. And I think that what we're seeing now, again, I would say that, people should be, in terms of this whole debate, 1973 and the 1970s really looms large. I would say, and there's the CIO at Guggenheim has made this point publicly, and I think he's onto something. I think people should maybe think about, in the United States, the early post-war period, 1945, 46, 47. It's not unexpected that there's going to be a bit of a consumer boom right now. Post-pandemic, services, goods demand. There's a bit of money in people's pocket. I think it's not hard to imagine that in the fourth quarter of this year, in the United States at least, that basically trails away. People have had their sort of post-pandemic sort of event, and all that, and they come back to the sort of hard reality of higher prices, wages not keeping up, and the cost of money and the supply, cost of money going up, supply of money going down.
Niels, do you have anything to add on to what Kevin has said there? And where does China fit into this as well? Just going...
Okay, I'll end with China just to add on to what Kevin said there. If you look already at credit card debt in America is going through the roof, as borrowers are already getting into stress and they can't keep up because the higher prices are eating into their consumption, and the cure for high prices is high prices. But you ask, will the Fed cut, swing the QT back to QE? The short answer is yes, they have no choice. I mean, they've created the situation. The inequality has been growing forever. What is my view on this? Unfortunately, the more you boost assets, the more capital in the economy will be, go into financial assets and not into the real economy. But the problem, the more the asset side of the balance sheet goes up, the more the liability side of the balance sheet goes up. Assets as a percentage of GDP, total household wealth, GDP in America is at an all-time high at 7 times. It's never been above 3 in history. So it's fine if everybody is that rich, but unfortunately there's debt against all that system. So the Fed has to make a choice that the consumer, if they must bail out the financial system rather than just fiscal response on the consumer, unfortunately the financial markets will win the battle again just because of their size. But what people tend to forget on China is everybody thinks it was just the Fed and the ECB that bailed out the world after the 2008 crisis. No, it was actually China. And they triggered that massive commodity boom we had from 2011 to 2014. The Chinese money supply grew by 35% per year over that period, and it was just the biggest fiscal response we've ever seen. They cannot do it again. They created their own property bubble around that they must address. They have overinvested in infrastructure. They're trying their best to create more consumption in society than just investment, but they've not been very, very successful at it because you need huge generational changes to change spending patterns. And even in America, it took 30 years from the World War II up to the 1970s to create a consumption culture. And so it's not that easy. So yeah, we tend to spend an awful lot of time talking about the Fed and its monetary policy, but we cannot leave China out of this because they have been the world's growth engine since the turn of the century. And things are not looking great in China.
Thank you very much for watching. We hope you enjoyed this video. If you would like to access this particular full webinar and our other services and analysis, you can do so in one of 2 ways, either by becoming a member of our YouTube channel, which you can click on the link below. Alternatively, you can go to our website and subscribe to the individual membership option for the price of 290 Rand a month to access all of our services. Thanks very much for watching. Until next time, this is Chris Hutton for the Center for Risk Analysis.